What's up everyone, it's Karthik with MoneyVest Real Estate, and in today's video, I'm going to be going over a very educational and very important lesson for all investors in real estate, especially in Dubai, because there are places and locations in Dubai where you can get very good rental yield, but there are also locations in Dubai where there is no concept of rental yields. It's going to be very, very difficult to cash flow. And so you're really going to be banking on this potential for capital appreciation. So of course, depending on the different strategies that investors have, whether it's off plan, whether it's secondary resale, whether it's capital appreciation, whether it's rental yield, I think this is going to be a very educational and very insightful video for everyone. So make sure that you drop a like and subscribe to the channel, and do me a favor and share this with other investors that you know about in real estate in Dubai. I would really appreciate that as we're trying to grow our community. And again, if you want to join, of course, be a part of our first ever MoneyVest Real Estate community. Link's going to be down below, and you'll have access to a lot of in-person events, a lot of meetups, as well as spreadsheets and different models that I'm building, and of course, more detailed analysis on a lot of different locations of real estate investing here in Dubai. So we're going to be talking a lot about different developers, locations, different opportunities, new upcoming projects. So we're more than happy to have you on board. So link's going to be down below. So let's talk about this concept of figuring out whether an investment is worth taking or not. Because when you look at the rental yields, right, and oftentimes when I've spoken to a lot of agents, they can tell you that, oh, you can get a nice 7, 8, 9, 10% ROI or, 10% rental yield. There's going to be a lot of numbers that are just thrown around when it comes to Dubai real estate or when it comes to rental yield. And our job as investors is to maximize our capital. Because if we're putting our hard-earned investments, hard-earned money into investing in real estate in Dubai, we have to make sure that we're maximizing our potential for profit. Because otherwise, there are better opportunities for our money. It's also called opportunity cost. And that simply means that if you're putting your money in real estate, you're missing out on the opportunity to invest elsewhere, right? That's what it comes down to, because all of us have a finite number of capital to work with. Right? Some people are working with a budget of 1 million dirhams. Some people are working with a budget of 100 million dirhams. But everyone has a finite amount of capital to put to work. So our analysis is always going to be in relative terms. Investment A has to be compared against investment B to better understand what's a better risk-adjusted opportunity. And that's where opportunity cost comes in. So in this illustration, I'm going to walk you through a very simple example to help you better understand whether something is worth investing in or not. So let's say that in this example, we're looking at a real estate property. We're looking at a property here in Dubai that is costing about 1 million dirhams. 1 million dirhams is the price to own this property. We also have to account for closing cost, because when we are closing, when we are transferring the property, we have to pay the 4% DLD, we have to pay the 2% commission, we have to pay a few more extra fees for conveyancing fee, legal fees, whatever, right? There are going to be some little bit extra fees there. So let's say that 7% is the closing cost. So that is an additional 70,000 dirhams for this transaction. So the total cash, let's say that we put into the deal, and this is not accounting for any leverage. We're not accounting for any financing or any debt in this illustration. Let's say I buy cash, 1 million dirham property, 70,000 in closing cost. So the total cash outlay, the total cash that I'm putting into this deal is 1,070,000 dirhams. Now, what we have to do is we have to, of course, do a calculation for the returns, right? What is the expected return from this property? Let's say that I've analyzed the rent to be around 100,000 dirhams. 100,000 dirhams for this 1 million dirham property, which by the way is going to be very difficult in this market, given a lot of different locations. But just to illustrate the point here, let's say 100,000 dirhams is the rent that I can achieve with this 1 million dirham property. Accounting for expenses, which is service charges, any kind of management or maintenance, we subtract, let's say 20,000 dirhams for expenses. So our net rent is 80,000 dirhams in this example. Net rent is 80,000 dirhams after accounting for expenses. So what is going to be the net rental yield? It's at 8%, right? 8%, that's simply 80,000 divided by the actual total cash outlay. In fact, it should be 1,070,000. So our net rental yield is 7.48%, so just under 7.5%. So a lot of investors might ask themselves, especially some of the beginner investors, like, is this 7.5% good or bad, right? That number in itself is not very decisive whether it is a good or a bad return. So we always have to compare any kind of returns that we're getting with the alternative, right? Investment A can only be looked at from the perspective of investment B. What is the next best opportunity? What is the next best alternative? Now, when you scroll a little bit further, we also have to account for the expected appreciation for this property, right? Not just accounting for the yield for the rent, but also looking at what is the expected appreciation for that property. And let's say that we assume a very modest, very realistic 2% appreciation for that property after 1 year. So expected appreciation is going to be, let's say, 20,000, right? Because it goes from $1 million, 2% is 20,000. So 1 year later, the property is worth $1,020,000, right? So the total return, once we add up the rent, the net rent, plus the expected appreciation, comes up to just about 100,000. Now that 100,000 divided by the total cash that I've put into this investment gives us a 9.35% net return, right? 1 year return on a net basis after accounting for the net rent plus the expected appreciation comes at 9.35. So now, once again, we have to ask ourselves this question: is 9.35% good or bad, right? What is that number in relation to other possible opportunities out there? Is it good or bad? And of course, there's a lot of places to invest. There's crypto, there's stocks, there's bonds, there's CDs, fixed deposits, and that's exactly what we have to do. We have to compare this number with other possible opportunities out there. And so what you can do is you can look at something like the risk-free rate, right? So the risk-free rate is essentially a rate of return that you would earn for taking the least amount of risk. That's why it's called risk-free. It's not 100% risk-free, but it's very close to risk-free. And the risk-free rate can be found in things like term deposits, fixed deposits, certificate of deposits, bonds, money market funds. These are places where you simply park your cash and the bank or the issuer pays you some kind of interest every year. So if you come over to the websites over here, so let's come over to HSBC, you'll notice that there is Grow Your Savings with Us. You've got interest rates up to 4%, right? 4%, USD rates are 4.1%, GBP rates are 4.05%. So these are your annual rates that you can earn simply by parking cash in a savings account, right? Now, if you were to invest in, let's say, government bonds, and let's just take the United States in this example, the US government bond, a 10-year treasury, which is a 10-year bond, is yielding 4.29%. A 30-year treasury is yielding 4.6. So 4.6 is for a 30-year treasury bond in the US. For 1 year, fixed deposits, term deposits with HSBC is just about 4%. So these are all risk-free rates because we are essentially parking our capital in these places, in these vehicles, and we're getting 4%, 4.5%, right? So that is a very good number to compare a lot of these investments to, because that becomes the baseline. That becomes the benchmark, right? Think of it as the lowest possible rate of return that you need to achieve in order for anything to make sense. So in this case, when we plug in a risk-free rate of, let's say, 4.6% is on a 30-year US bond, now we get to a risk premium. The risk premium is essentially the premium return that we're getting for taking on risk. Okay? So if we simply put capital into a fixed deposit, we're guaranteed a 4% rate of return by the bank. If you invest in a government bond at 4.5% or 4.6%, we're guaranteed that rate of return by the government of the United States. Or any other government, right? Depending on which bond we're choosing. But the risk premium is the premium in return that we're getting for taking on the risk of investing in something that is something like real estate that has a risk component to it. Property prices can appreciate, they can depreciate, rent can go up or down. So this 9.35% is obviously not guaranteed. It's not guaranteed by the market at all. It depends on market forces and our expectations. So that's the risk premium. That's the premium that we're getting for taking on the additional risk of not investing in bonds, but instead investing in real estate. So every investment, in my personal opinion, in my 10 years of doing this, every investment opportunity that I analyze against the next safest opportunity, which is in this case always the risk-free rate, which is what are the bonds paying us? What is the bank paying us? And can we at least beat that rate of return? Because if you invest in equities, right? If you invest in, let's say, stocks, and if a stock is giving you 2% return and the bond is giving you 5%, what's a better investment opportunity? It's the bonds, right? Because bonds are less risky, they're more safe, and they're giving you a higher rate of return. So there's absolutely no reason for you to be investing in that stock. Similarly, if this property, let's say you bought it for $1 million and it was only making, let's say, 60,000 dirhams in rent, and now your net rental yield is 3.74% after all the expenses, and the property appreciation is, let's say, 2%. And so now your total 1 year return after 1 year, accounting for the rent, accounting for the expected appreciation, is 5.6%. So your risk premium is just 1%. Now you have to ask yourself this question, like, oh, I'm doing all of this work, I'm putting all of this hard work and analyzing and closing this deal just for an extra 1%. Does it make sense? Is it worth my time? Right? So those are some things that we have to analyze, on an annual basis. Now, one more thing I will point to is, yes, there's always that opportunity that prices will continue to appreciate, right? Because expected appreciation here, we've taken 2%. Let's say the property appreciates by 5%. Now your risk premium is not 1, it's almost 4%. So that, that component is always there. But also with reward comes risk, and that is that it is an expected appreciation. It may or may not happen. Prices can also depreciate. It can also go down by minus 2%, and then all of a sudden your risk premium is actually negative 2.73%. So, when you're taking on risk, it is very important to compare that investment opportunity with the next safest, best possible option out there, so that gives you a bit of an idea on whether what you're investing is worth your time and your effort and your hard-earned money, or if there are better places to park your cash. So hopefully this gives you a little bit of an idea. So that's why every time I do an analysis, I'm looking for a net rental yield without appreciation to be over and above the risk-free rate, because if that's the case, then it makes sense for me to take that investment, because the capital appreciation is uncertain. It's not guaranteed. It may or may not happen. Property prices may go up, they may go down, we don't know. But if the rent keeps coming in, if the cash flow is good, then just from the cash flow alone, the property makes sense. The net rental yield makes sense. And so that's how I go about investing. And of course, looking at these properties and risk and reward is to figure out the net rental yield and then comparing that with the risk-free rate. And if it makes sense, great. If it doesn't, move on to something better. So hope you all enjoyed this video and found it helpful. Make sure that you drop a like and subscribe to the channel. Again, link's going to be down below if you want to join, be a part of our MoneyVest Real Estate community. As always, happy investing. I'll see you all in the next video.